We do have those earnings coming in any moment now, but let's break down today's action so far with Tom Lydon. He's from Global Trends Investments, telling us why he thinks it's time to move away from large cap stocks. Rob McGeever from Jensen Investment is calling for a rate hike before the end of the year. He's got 3 ways to play it. And Alan Nuckman at the pits of the CME. Alan, let's start with oil. Is this all about inflation, which is way down again?
It's really about the dollar. The dollar surged one more time and another big pop. You saw the euro currency get knocked down to the 112 level. So it's flirting with the recent lows that we saw in the end of January. So that put pressure on crude. Again, in crude, this is only the 3rd session in the month of February that's closed below $50. So that's an important pivot. But I want you to step back and look at things on a weekly basis, see where we are at the end of the week, because that's very important.
Indeed, indeed. But it's still great for consumers when that chart starts to tick downward, Tom. Let's talk about how it affects the overall picture for the markets today. We did see yet another record for the Russell 2000. How much conviction now is behind stocks at the moment here in the U.S.?
Well, Liz, I feel like I'm a broken record, but you got to remain bullish. I mean, seeing this 4% decline in oil again today, keeping oil below $50 a barrel, that infuses the extra money in your pocket for the average investor.
Okay, let me interrupt you. One quick second, Tom. We do have Gap earnings, Gap numbers here, and Joe Lynn Kent has them.
Liz, hey, that's right. We've got a beat on the EPS, 75 cents versus the Street's 74-cent estimate. And then we have a revenue coming in, meeting Street's expectations, coming in at $4.71 billion. The headlines now from this earnings report, a $1 billion share buyback from Gap. Same-store sales also up 2%. We're also seeing decent sales at Old Navy globally. So that, of course, is their lower-end fashion line. So we're looking at a decent earnings report from Gap. They beat on EPS and they meet on revenue.
How about this? Gap is seeing negative impact, David, of about 4 percentage points due to delayed merchandise receipts at the West Coast port situation.
Yeah, the ports are really hanging in there, causing trouble all over the place. Although the stock is holding its own. In fact, it's up just a tick. You should keep in mind that the Gap, the shares have fallen there. They've fallen about 4.2% so far this year, actually down about 8% over the past 12 months. So it is time for an uptick in Gap. Rob, I want to go to you and talk a little bit about what may be affecting all stocks in general, and that is concerned about interest rates. Do you have any idea where they're going to be going? We had another Fed governor on today earlier with Maria suggesting that we are going to have full employment by the end of the year and probably a rate cut before then. What do you think?
Well, certainly full employment would be good news after 7 years of some very trying economic times, wouldn't it, David? I think the reason the Fed is indicating that interest rates are likely to rise, it's not a question of if, it's when, is because the economy is fundamentally sound. But that might put some stress on some companies that have led the charge in the recent bull market, and perhaps an opportunity for investors to become a little bit more defensive to protect themselves on the potential downside there.
Well, that's the thing, protecting yourself on the downside. And Alan Nuckman, we just finished talking about puts and calls. And I'm just wondering if you're looking at the overall market or individual names in your portfolio and you know interest rates are going to tighten, is that necessarily a sure thing that it's going to be negative for stocks?
No, not at all. I think the market could react positively because then the elephant's out of the room. We've been talking about this exhaustively for years and years and years. So, you know, a rate hike of 0.25%, who really cares? But I think right now it is time to get a little bit more defensive because we've had such a move in the last 3 weeks that I'm looking at some Dow stocks that have been dogs. I'm looking at Coca-Cola, Microsoft, and GE. GE's been getting a lot of interesting attention in the options pits lately. A lot of unusual option activity, and that's usually a sign that smart money is looking for a move.
Such as what?
Well, they're looking at the April 26 calls, buying 40,000 of those options. GE was the #2 most traded option contract yesterday in the equity market, and it's been a stock that's been stuck between 24 and 27, so it's really done absolutely nothing. So, you know, I think someone has the feeling, a strong opinion, that some move is coming, and a breakout above 28 takes it to 32, which is about 20% higher. So I don't think there's a whole lot of risk in something like GE because it hasn't rallied, you know, with the market. I think there's more risk-reward potential in some stocks like those.
Okay. On the other hand, Tom Lydon is a little suspicious of the big cap stocks right now. Why, Tom?
Well, these global multinational, David, I'll tell you, with that currency fluctuation that we're seeing in some of these developed countries, it's more expensive for them to import our products. However, that doesn't mean that it may not continue. I think the biggest thing, though, if I can take a second, is as we talk about Janet Yellen and the fact that she is going to be pulling the trigger, if you don't start making moves on the fixed income side between now and then, you're going to get burnt. And there's one rock star that just entered the ETF space, Jeff Gundlach, who entered with his own ETF, partnered with State Street this week. The State Street double line turn tactical ETF.
Okay, tell us specifically tell us what's in that ETF. What kind of stocks are we talking?
Well, you're talking about all different types of bonds, not just conventional bonds where you've got corporates and treasuries, but you've got sovereign debt, you've got emerging market, high yield, those types of things where he can decide whether he's all in or out. So it's TOTL, something to think about because we haven't had this much excitement, especially in the fixed income ETF area.
Okay, you know, if you're less inclined to go with the large caps, Rob is going with some pretty big names. Rob, you like DuPont, you've got Accenture, United Health Group. Why are you unafraid in those realms?
Well, we think, Liz, that the important thing here are we own companies with proven business models, robust balance sheets, and importantly, very strong returns on equity. And so we build the portfolio one company at a time. And as we think about the big needle movers that long-term investors need to be focused on, DuPont, if you think about his expertise in science, technology, feeding the world, we think that's a very compelling case. The same with Accenture, which leverages its expertise in globalization, technology expertise, and in business productivity, very, very compelling for the long-term investors, and of course, less interest rate sensitive.
Alan Nuckman, this is the end of the Chinese New Year. The folks in Hong Kong and elsewhere in Asia are back, and they are apparently buying gold. We suggested this may happen last week when gold was way down. We say maybe then was the time to get into it. Without the buying from China, would gold have been down today? In fact, some people suggest it would have been down big time without the buying from China. What do you say?
I don't know who's exactly in play right now, but it is the year of the sheep, just in case you're wondering. But gold has found somewhat of a base.
The golden fleece, let's remember that.
The more importantly to me is how the market reacted. With the strength of the dollar, gold was still positive and holding above 1,200. So again, I think the risk on it is down to 1185 or so. But if we get back to 1225, you can see another round of short covering. If you remember how that played in the marketplace just a couple of months ago when everybody was getting short gold, it did bounce up. So I think the psychology is ready for that one more time.
Tom, what would you completely stay away from?
Well, right now, I think utilities are kind of in a tough situation. Again, when you think about interest rates and the average investor, Liz, just isn't prepared because we haven't seen it in so long. So yes, there's equity risk, but earnings in general seem pretty good. And though I'm a little less optimistic about large cap, I really like small cap and I really like mid cap right now because they're going to revert to the mean.
God, I hate interrupting Tom. This is twice, but we've got J.C. Penney. Sorry, Tom. Joe Ling, how did Jack Penney do?
Liz, J.C. Penney had a big miss on EPS. It earned nothing per share. The street was looking for 11 cents. Revenue came in at $3.89 billion. That's actually a beat of the 3.87 the street was looking for. Their comps, their store comps are up 4.4%. Looking ahead to 2015, J.C. Penney says that they plan to see 3 to 5% same-store sale traffic increase. So slightly better news there, but JCP really missing on EPS.
Okay, by the way, we should mention there that the stock is up 40% year to date. Of course, it had been beaten down terribly. Our guy, J.C. Peretz, is going to be along later, suggested you get into it before it had that 40% pop. He was right on target. Rob, it brings me to ask about the consumer and what is happening with the consumer. We've seen some better numbers with regard to wages by the consumer, and of course, they have more money in their pocket because of the gasoline savings, but hasn't really translated a lot of buying, has it?
Not a huge amount yet. I think we've been through such a difficult period, David, with the Great Recession and the financial crisis. People have been focused on repaying debt. But having said that, the outlook, we believe, certainly for the U.S. economy, is fundamentally sound, certainly compared to the routes that the Europeans took with austerity. So I think longer term we're good. But again, within the market exposure that investors look for, perhaps a time to be a little bit more defensive by buying higher quality companies.
Higher quality, always, right? You want that.
Absolutely.
Good to see all of you.
Rob McGeever, Tom Lydon, and Alan Nuckman will be back with you in just a couple of minutes when the S&P futures close. Thanks, guys.